Recently, the general manager of Mitsubishi in Australia blamed the Australian government for it not having any electric cars to sell, and it believes the government is at fault for the slow uptake of EVs in Australia. Ironically, Mitsubishi doesn't have any EVs to actually sell, and that's the reason why it just exited China. The most lucrative, profitable car market in the world, believe it or not, that is actually China, is a market where Mitsubishi has, had several factories. It had joint venture business projects. It sold cars there, and it admits it left because it had no compelling product that the Chinese people wanted. Specifically, no compelling electric cars. Hello, my friends. Welcome to the channel. I'm Sam Evans. You're watching the Electric Viking. Mitsubishi Motors Corporation announced the termination of its joint venture agreement with Shenyang Aerospace Mitsubishi Engine Manufacturing Limited, which is actually Shenyang Aerospace Mitsubishi, marking the Japanese automaker's official complete withdrawal from China's automotive manufacturing sector. This decision follows the end of its local car production in 2023 in China and underscores Mitsubishi's running away from China as the Chinese car market moved to new energy vehicles. Now, Mitsubishi has massively scaled back its operations in China, and over the years, it's actually realized no one wanted its cars. It has actually ended vehicle production and halted domestic metal trading, which was a big part of its business there. Now, this decision comes from a combination of factors, including a copper fraud scandal that impacted its trading unit in China and led to it losing $80 million from this fraud scandal. It's also been facing, a challenge it can't beat. If you don't have an electric car to sell, then what are you going to do? Now, there's a lot of factors contributing to this. Vehicle production. Mitsubishi Motors decided to wind down its vehicle production and officially ended in China last year after exiting its joint venture with Guangzhou Automobile Group, or GAC. GAC is actually a very successful car company in China. Reasons for the exit. The company faced declining sales and struggled to compete with the rise of Chinese domestic brands, particularly in the electric vehicle sector. Joint venture. Mitsubishi will transfer its stake in the GAC Mitsubishi joint venture to GAC, which will continue to use the production site for its own EV production. GAC actually sells very good cars, and at one point, GAC was selling 50,000 EVs per month. Financial impact. Mitsubishi expects to lose approximately $1 billion from its venture in China. That's some pretty big numbers for a relatively small car company. Mitsubishi also has faced some other challenges, and the name has been dragged through the mud a little bit. There's been a copper fraud scandal that has just come to a close. Mitsubishi Corporation has stopped domestic metal trading activities in China after a copper fraud incident resulted in a loss of around $87.5 million US. Impacts on operations. The company decided to discontinue new domestic metals trading transactions in China, and it's unwinding its existing deals. It's basically exiting China on all fronts. Future operations. Well, I'm not sure there's going to be any future operations for Mitsubishi long-term, and I mean long-term period worldwide. I would probably discourage anyone from buying a Mitsubishi car because I don't believe the company will exist in terms of its automotive sector after 10 years. Its other sectors are actually quite profitable in terms of air conditioning, those sorts of things, HVAC systems. But when it comes to cars, they're being very quickly left behind. Mitsubishi's China journey actually began in 1973, says Car News China, with exports of medium-duty trucks. By the early 2000s, its two-engine joint ventures supplied powertrains for 30% of all cars produced in China. 30%. However, the rise of China's new energy sector, coupled with weakening demand for internal combustion engines, completely eroded its market position. The formation of GAC Mitsubishi in 2012, a 50-30-20 joint venture with Guangzhou Automobile Group and Mitsubishi Corporation, initially showed some strong promise. Sales peaked at 144,000 units in 2018, driven by the Mitsubishi Outlander SUV's 105,600 sales. However, annual deliveries plummeted to 33,000 units by 2022 amid intensifying competition from domestic EV brands. By March 31, 2023, GAC Mitsubishi reported total assets of $582 million and liabilities of $780 million, according to GAC's disclosures. In October 2023, Mitsubishi announced plans to halt local production and restructure its Chinese operations. GAC subsequently took full ownership of the joint venture with plans to repurpose the plant for its EV brand, Aeon, aiming for mass production by June of 2024, which they successfully achieved. Mitsubishi's exit reflected broader challenges faced by many foreign automakers. Jeep, for example, declared bankruptcy last year in China. China's automotive landscape has become a battlefield for EV innovation where legacy automakers are struggling to compete, said industry analyst Chen Liwei, quoted by Chinese media Gmen News. Mitsubishi's retreat highlights the irreversible shift towards homegrown solutions. And it shows you just how quickly car makers, if they're not prepared for the future, if they're not prepared to sell products that people want. I mean, Toyota says people don't want EVs, but if that were the case, then why are electric car sales this year up by 30%? Why is it that 1 out of every 4 cars sold this year has been electric? The demand is clearly there. What is needed is simply the product and the dedication to innovation, which Mitsubishi unfortunately wasn't interested in. Was it easy pickings to make money from EVs? Absolutely not. It's been very, very challenging for the companies that have succeeded in doing it. But if you can succeed, it means you're going to be part of the future. Thanks for watching. A story has just emerged of what is actually happening to Mitsubishi in the United States, and it could be about to get much worse. The story starts off by sounding really positive. It's all about this so-called new electric vehicle that Mitsubishi are going to bring to the United States, and then it kind of changes. I was reading this story thinking, okay, Mitsubishi are going to bring this new electric car to America. What is it? I'm going to find out what it is, tell you guys if it's good. Apparently, it's going to be made by Nissan, rebadged. Made by Nissan, by the way, in Japan, rebadged, and basically they were going to slap a Mitsubishi sticker on it, then send it from Japan to the US. And obviously there's a 25% tariff on that car. I was curious to know, I'm thinking to myself, how are they going to get around the tariffs? And then the article changed dramatically. Hello, my friends. Welcome to the channel. I'm Sam Evans. You're watching the Electric Viking. Great to have you with us. Now, I'll spare you the details on the so-called third generation Nissan Leaf, which is going to be rebadged to be a Mitsubishi for Americans to buy. Might be some different body cladding as well. I don't really know. But what I think is the most intriguing here is this. Of course, Mitsubishi will be affected by the tariffs enormously. In fact, a huge percentage of the parts in Mitsubishi's cars, approximately 50%, comes from outside of America. So you're looking at 25% tariffs.